Over the past few years, I've witnessed a dramatic shift in how Chinese capital engages with global markets. What was once a flood of investment has turned into a controlled trickle, driven by strategic objectives. This isn't just a minor adjustment, it's a fundamental reimagining of the world's second-largest economy's approach. Chinese regulators now view cross-border investments as tools of national strategy, not just commercial moves. This transformation took years of careful planning and policy coordination at the highest levels of government. It's no coincidence that this shift aligns with rising geopolitical tensions and the recognition of economic vulnerabilities. What's striking is the sophistication of this approach. Subtle regulatory changes that many missed. We're seeing a quiet revolution in global capital flows, impacting everything from corporate financing to real estate markets. And believe me, we're just at the beginning of this significant change. Chinese regulators haven't just banned outbound investment. They've crafted a maze of approvals and restrictions that steer capital flows according to strategic goals. First, there's a classification system that ranks investments by their value to China's long-term interests. If an investment aligns with tech advancement or resource security, it gets a green light. Otherwise, it's scrutinized heavily. Next, the approval process is now a lengthy ordeal, requiring mountains of documentation and strategic justification. This bureaucratic complexity can deter many potential investors from even trying. Most crucially, there's a risk assessment that weighs not just financial returns, but geopolitical implications. Investments in sensitive sectors face extra hurdles, while those that align with China's objectives are fast-tracked. This system gives the illusion of a free market while allowing the state to control capital flows with precision. The impact on American markets has been immediate and multifaceted. We're seeing effects across multiple sectors from technology and real estate to manufacturing and financial services. The withdrawal of Chinese capital has created funding gaps that American companies are scrambling to fill, often at significantly higher costs. In the technology sector, the effects have been particularly pronounced. Chinese investors were major players in American tech startups, providing not just capital but also access to Asian markets. With that funding source largely unavailable, American tech companies are finding themselves competing more intensely for domestic investment. This competition is driving up valuations in some cases, while leaving others struggling to secure adequate funding. The real estate market tells a similar story. Chinese investors were once key players in American commercial real estate, especially in big cities. Now, their withdrawal is shaking things up, causing price pressures in some markets. But with challenges come opportunities for other investors to step in. We're seeing a shift in how American companies think about growth. With less Chinese capital available, firms are rethinking their strategies. They're focusing on markets where they can find reliable funding partners. This is leading to a new direction for American business, exploring other regions and investment sources. The corporate bond market is shifting, and it's a big deal. Chinese institutions used to buy up American corporate debt, keeping borrowing costs low. Now, with that demand fading, companies are facing higher interest rates. But it's not just a retreat, it's a transformation. We're seeing a new financial architecture emerge, one that could rival the West. This system is built on bilateral agreements, facilitating trade without traditional banks. Local currency settlements and streamlined regulations are the new norm. It's a strategic move, making it easier for countries to do business together. One of the biggest shifts in finance is the rise of alternative payment systems. China is stepping up, creating networks that bypass Western control. These systems connect with partner countries, forming a new financial landscape. The impact? Countries can now trade without fear of Western sanctions. It's not just tech, it's a whole ecosystem with new rules and frameworks. China aims to build a financial system that operates on its own terms. The shift in capital flows is reshaping global trade patterns, and it's not just about China and the US. We're witnessing new trade corridors emerging and existing partnerships strengthening. Southeast Asia is a major beneficiary of this shift, with Chinese investments skyrocketing. It's not just manufacturing anymore. We're talking tech, finance, and services too. These investments are creating new supply chains that lessen our reliance on Western markets. It's a whole new commercial landscape, and the future looks bright. The Belt and Road Initiative isn't just a buzzword anymore. It's reshaping global economics. What started as a simple infrastructure plan has morphed into a powerful framework for economic integration. This initiative is creating new economic realities, especially in Africa and Latin America, where Chinese investment is booming. These partnerships offer alternatives to traditional Western models, giving countries more flexibility and autonomy. We're witnessing the rise of new multilateral frameworks that bypass Western institutions, fostering trade and investment on their own terms. This is more than just a trend. It's a parallel system of international relations that could redefine the future. The impact of inflation is becoming hard to ignore. While it's not the only factor, financial restructuring is keeping inflation high in developed economies. This is a real challenge for central banks and policymakers trying to juggle competing goals. Looking ahead, this financial shift could reshape the global economy for decades. We might be seeing the rise of parallel financial systems, leading to a fragmented global economy. Different regions could operate under different rules, affecting global market efficiency. The US will still be a major player, but its influence may wane, pushing for more collaboration. Other countries might find new growth opportunities outside Western financial systems. Technological advancements in payment systems and digital currencies could spark innovation. Competition among financial systems could enhance efficiency and accessibility for everyone. While headlines scream about trade disputes and political tensions, the real story unfolds in the movement of capital and the rise of new institutions. We're witnessing a transformation in international commercial relationships still in its early stages with an uncertain outcome. The global economy of the future will be vastly different from what we've known for decades. The Western-dominated financial system post-World War II is being challenged by innovative models of economic relations. For investors, businesses, and policymakers, understanding these shifts is crucial to navigate upcoming challenges and opportunities. Those who adapt to this new reality will thrive in the emerging global economy. The question isn't if this transformation will continue, but how fast it will accelerate and what the end result will be. We're living through a historic moment in economic history, and today's decisions will shape the future for generations. Thanks for watching. Don't forget to subscribe for more insights into the evolving global economy. What are your thoughts on these developments? Share in the comments below, and I'll see you in the next video.